So what exactly is fundamental analysis? When we talk about fundamental analysis, basically the analysis is of two types. One would be fundamental, one is technical analysis. So when we do analysis with respect to charts, demand and supply, and other parameters, we call it a technical analysis. So when we see a chart like x-axis and y-axis, and chart is appreciating, the prices are appreciating or depreciating, or maybe there is a Bollinger Band, or candlestick patterns. We talk about technical analysis. So technical analysis is basically dependent on the demand and supply of the price fluctuation. But when we talk about fundamental analysis, we talk about various statist qualitative as well as quantitative dimensions. So when we talk about qualitative dimension, we are very much keen on what the management is offering, what exactly the product is, or how the product is related to the specific industry, or what is the demand and supply conditions of the product, or maybe what price the product has been offered with respect to the competitor's price. Or maybe when we talk about qualitative analysis, we talk about the quality of the management of that particular company. For example, Tech Mahindra, managed by Mahindra Group, or for example Birla Group managing Aditya Birla Novo. So we talk about the qualitative aspect, and when we talk about the quantitative aspect, we come to the balance sheet, we come to the income statement, we come to the cash flow analysis of a particular company. Or also when we are doing sectoral analysis, we try to find what are the particular quantitative aspect which are impacting a particular sector's performance. So for example, when we talk about the auto sector, we are very keen on the auto sales which are being announced on 1st of every month. Or for example, when we talk about the crude, or when we talk about the metals, we are very keen on the inventory. So those are more like the quantitative aspect. So when we are talking about a company analysis, we are more concerned about the qualitative and the quantitative aspect with respect to the fundamental analysis. So what exactly the fundamental analysis is offering us? Fundamental analysis seeks to identify the fundamental economic and political factors that determine the asset's price. Now when we are talking about an asset, the asset is basically, asset can be a stock, maybe a security, or etc. It is basically an analysis of the current and the future demand for and supply of the commodity to determine if the price change is imminent enough, and in which direction, by how much prices are expected to change. So when we talk about fundamental analysis, and when we talk about the valuation concept with respect to the fundamental analysis, what we are doing is we are either compounding or else we are discounting. So when we compound or discount a particular asset, in this case we are at, if we talk about a timeline, in case of compounding we are, for example, we are standing here at X, so we are compounding it to Y. But in case of discounting, we have already discounted the Y price, and now we have already compounded the Y price, now we are discounting it to X at a particular interest rate. So this is called the discounting method. So for when we do the valuation, we are discounting for next a few years and then we kind of discount it to the present scenario. For example, you must have seen in the reports in certain reports it gives the performance of the present year, then the future years, and then there is something called 2017E, 2018E. So this E represent the expected. So if we, when we as analysts we are very kind of making assumptions. So when if suppose we have to make an assumption for net sales, so we are having a net sales of 100 crore, maybe 150 crore next year. So now we expect or we expect on the basis of certain parameters that the net sales would be 170 crore in 2017 and 190 crore in 2018. So these are the expected net sales, and going forward we will talk about the FCFF, the free cash flow to firm, and then in the same case the FCFF is being discounted from 2018 to 2015, and then we are analyzing a particular company and eventually making the valuations come alive. So fundamental analysis focuses on cause and effect. Causes external to the trading market that are likely to affect prices in the market. So there are certain causes which are likely to make the price changes, and we are talking about those causes fundamentally. These factors may include the weather, current inventory, government policies, economic indicators, trade balances, and even how traders are likely to react to certain events. For example, if the Met Department comes and tells us and estimate that there is or anticipate that there would be a good monsoon this year, so likely we can see a rise in agriculture stocks and eventually the auto sector stocks, because they are directly impacted with the agriculture products. So when we talk about the conditions, there are macro aspects which are affecting. Maybe there is a Fed policy coming into the picture and we might see a volatility in the stocks, or might be there is a possibility that there is a monetary policy maybe next month, so we might see a volatility in the banking stock this month itself. So based on those parameters we can see there is a cause and then there is an effect to it. Fundamental analysis maintain that market may misprice a commodity in the short run, but that correct price will eventually be reached. For example, what market estimates is that the assets price would be rupees 100 at present, and the market anticipate the price discounting the future cash flows. The price should be approximately 170 at the current levels. So there is a mispricing of 70 rupees. So this 70 rupees is the mispricing of the market, and the market participants kind of anticipate that in the long run this 70 rupees will not be there, and hence in the short run they try and capture this mispricing of 70 rupees and kind of buy this particular asset. So profit can be made by trading the mispriced commodity and then waiting for the market to reorganize its mistake and correct it. So in the short run they will try and capture this mispricing of 70 rupees, and they will anticipate that in the long run this will eventually fall to 170, and then they might short the position or might sell the stock. Economic industry company analysis. So in the top-down approach, first of all the overall economy is analyzed to judge the general direction which the economy is heading. So when we talk about the top-down approach, we analyze the economy and then we analyze the industry and then the company. So the direction in which the economy is heading has a bearing on the performance of various industries. So for example, there might be in the recent past we have seen that there is a Greece issue which was coming into the picture. So in this case there is a economic condition which is not very favorable to market, and hence we saw the Athens stock exchange coming down, and eventually because we are globally connected, then Athens stock exchange coming down will affect the Europe stocks prices and US and then eventually Indian prices. So we saw very havoc position when the Greece issue was into the picture. So that was an economic condition affecting the markets. That's why economic analysis is important. The output of economic analysis is a list of industries which should perform well given the general trend of the economy, and also an idea whether to invest in not in the given economic conditions. So now we talk about investment, speculation and gambling. What is the exact difference in between? So when we talk about investment, we are talking about future returns. So when we talk about investment, it means employment of funds for earning some returns. So why we invest? We invest to earn at least some return. It means deferment of current consumption so as to have higher future. An asset or item that is purchased with the hope that it will generate income or appreciate in the future consumption. In an economic sense, an investment is the purchase of goods that are not consumed today but are used in future to create wealth. In finance, an investment is a monetary asset purchased with the idea that the asset will provide income in the future or appreciate and be sold at a higher price. So if I buy something today, we are expecting that the price of this particular asset will maybe XYZ, this particular asset will appreciate in the near future, and hence I have made this investment so that I can reap the profit in the near future. So but when I talk about speculation, it means undertaking considerable risk and commensurate gain. So for example, I am taking an unnecessary risk to make some gain in the future. The act of trading in an asset or conducting a financial transaction that has significant risk of losing most of all initial outlay. So now we are talking about an element called risk. Now this risk, when we talk in financial terms, when we talk about risk, we are talking about the standard deviation of this particular asset. So if this is high, it means the risk is quite high. So risk is high means the stock might from 100 rupees might go to 105 or might come down to 95. So if I am talking about a risk of rupees 5. So stock is highly volatile when I am talking about the risk. The risk of losing most of all of the initial outlay is expected or substantial gain. For example, in case of speculation, we are expecting a substantial gain, a big gain, but there is a risk of losing almost everything that we have invested. With speculation, the risk of loss is more than the offset by the possibility of huge gain. Otherwise, there would be a very little motivation to speculate. So when we are taking a huge risk, a risk of 100%, that means that we are expecting a very substantial gain. We are not talking about a gain of 5 to 10%, we are talking here about a gain of 50 to 100%. So due to the presence of speculation, the stock market works smoothly. Now there is this irony that due to speculator, the stock market works smoothly. Speculation, the risk of loss is more than offset by the possibility of huge gain. Otherwise, there would be a very little motivation to speculate. So where we are expecting a huge gain, otherwise we are not very much motivated to speculate the position. So due to this presence of speculation, the stock market works smoothly. So when we talk about this, becomes an irony that due to the presence of speculator in the market, the stock market will work smoothly. Right? So the market, this means the market are not very much efficient, and hence we are making the most of it. Gambling. Now the other trend is gambling. It is different from investment and speculation. The result of gambling is known more quickly. The outcome of roll of dice or a turn of card will get an immediate result, and hence proves to be a gambling. When we roll a dice, we are expecting that there would be a figure which are out of 6. So 6 may be the highest, then 5, 4, 3, 2 or 1. And when there might be a situation that there is a true or false. So either true or false. So either you will get or you will lose. So there are only two parameters to it. So rational people gamble for fun, not for income. Gambling does not involve a bet on economic activity. It is based on the risk that is created artificially. So gambling creates risk without providing any commensurate economic return. Now when we talk about investments, there are few certain aspects which we need to understand. So there are certain elements like return, risk, liquidity, marketability, tax benefit, hedge against inflation, safety of capital. So when we are talking about investment, we are talking about risk and we are return, and we are taking certain risk to get that return. And there would be a high level of liquidity in the market so that we can sell, we can purchase a stock and then we can sell the stock as soon as possible or maybe after some time. Or there would be a marketability. I mean, if you are buying a stock, we are buying it for the only reason of the appreciation against that particular price. And if there is no marketability, there would not be any appreciation. Sometimes people buy to get the tax advantage. Because, for example, LTCG benefit people might get if they hold the position for more than 12 months. So for that position, people kind of invest. And then they hedge against inflation also. So there is a point that we have to hedge against inflation. For example, so we are getting a rate of say 8% annually in a particular instrument, and the inflation rate is actually approximately 5%. So basically the inflation rate is 5% and we are getting only 8%, and we are getting only 3% over and above inflation. So this 8% becomes 3% if inflation is 5%. So we have to hedge against inflation, and that is the reason we are investing in markets. So when we talk about investments, we have a decision process. Budgeting cash flow and capital needs. You should begin by determining how much you can and need to invest. So we should be clear of the fact that we have to invest a certain quantity and not exceed that particular quantity. To calculate how much you can afford to invest, you will need to build a budget and analyze your cash flows. So we have to analyze what exactly we are getting in and what exactly we are investing out of it. Next becomes determining the right asset allocation. How much of your capital need to invest into the different categories of investments, such as stocks, bond, or maybe cash. So this is again a very important aspect, asset allocation. So when we are allocating certain money to assets, we are talking about cash, we are talking about stocks, and then they are talking on bonds. So cash is something which will invest in stock and bond, and we will hold certain cash so that if there might be a scenario that the market might turn highly bullish in coming 6 months, so we will hold some cash so that we can invest it accordingly. Or might be a scenario that I am not going to take much risk as of now, and hence I'll invest it maybe after some time and I'll hold that cash. So I'll invest the cash into stocks and bonds. When I'm investing the cash into bonds, I'm talking about the risk-free rate. I mean that this particular instrument is not exactly risky as compared to the stocks. So I'm talking about a risk-free rate of say 8%. So I'm getting 8% return on investing in a bond. So if I'm a highly risk taker, if I'm taking high risk, I will invest my amount in stock market, because when I'm talking about high risk, I'm talking about high return. So I'm an aggressive investor, I want high return on my portfolio, I'll invest more and more into the stock market and rather will not invest much into the bond market. For example, I'm a 80 years old guy and I'm not taking much of the risk, but I want a constant return every year. So I'll be investing much into the bond market and I will not be investing into the stock market. So that becomes asset allocation. How much you are investing in the stock market and how much you are investing in the bond market. We can also add real estate to it and other assets. But I am talking about stock and bond. Now I am holding certain in the cash market also. so to be on the safer side, I'll hold some amount in the cash market also. Selecting financial instrument, you will then get the opportunity to choose individual bond, equity, mutual fund, and other financial instrument in your portfolio. So when you're talking about a portfolio, you might be having a mutual fund, you might be having certain equity instrument into a portfolio, then you might be having certain derivatives which are again included in the equity segment only. You might be having certain bonds, and then you might be having certain real estate investment. Sometimes people do have certain artifacts also, so that would be catered in other alternative assets. So again, coming back to the risk, the chance that an investment actual return will be different than expected. So what is risk? Risk is we are expecting a certain return, or maybe we are expecting something out of our investment, and that is the actual return is different from that something. So that is a particular risk. Risk excludes the possibility of losing some of or all of the original investment. So as I have said before, you might just lose everything you invested, or you might just lose some amount of it. Different versions of risk are usually measured by calculating the standard deviation. As I have told, if you are talking about the risk, we are talking about the standard deviation. So standard deviation is basically denoted by sigma when we talk in finance. So high standard deviation indicate high degree of risk. So if the standard deviation is 5% and the standard deviation for other asset is 10%, this is a higher standard deviation when compared to the 5%, and hence this is highly volatile, highly risky. So when I am talking about high risk, then I am taking this particular risk only because I am expecting a good return out of this 10%. So here I would be expecting say 15% return, and here I am expecting only say 8% return. So I am expecting more, and hence I am able to take more risk. Return, the gain or loss of a security in a particular period. The return consists of income and the capital gain relative to an investment. It is usually quoted in percentage. So return, say as I have told, 15%, so it is usually quoted in percentage. That means if I have invested 100 rupees, I am taking a risk of 10% to get a return of 115 in the near future, or maybe in certain time. So as we have discussed before, the effects, this is basically economic analysis. Now in economic analysis we talk about the business cycles, the monetary policy, the physical policy, inflation, interest rate, foreign trade, unemployment, GDP growth rate, all the macro aspects. So when we are talking about the Fed rate, we are talking about say monetary policy of Mr. Raghuram Ranjan, we are talking about the economic analysis. Then we are coming down to the industry analysis. So in industry analysis we talk about the demand supply relations, the industry structure, maybe the competition cost, or maybe the competitive advantage of one company over the others. When we are comparing HUL when we are with the Patanjali, or maybe we are comparing HUL with Dabur, we are talking about industry analysis. When we are taking all the FMCG segment in one roof, under one roof, we are talking about industry analysis. When we are taking all oil and gas segment under one roof, we are talking about industry analysis. So we are basically analyzing the whole industry. So in annual reports itself, the company announces certain industry growth rate. So for example, the company says that the industry, for example, NASSCOM says that the industry will be growing at the rate of 12%, and a company called Infosys or maybe TCS comes and tells that will be going at the rate of 11%, or we are beating the industry estimates of 12%, that means they are growing at the rate of 15%. So accordingly the stock reacts. So we are talking about the industry analysis when we are talking about all the stocks under one roof. Then comes the company analysis. So when we are talking about company analysis, we are talking about expected earnings. So as I have told before, when we are from 2015, we are heading forward to 2018, and then we are expecting some earnings out of there, and then we are discounting those things in present case scenario. We are talking about company analysis. We are also talking about dividends. We are talking about funds position, accounting policy, and risk and return framework. So that is exactly a company analysis. So first of all, we need to do the economic analysis, and then we come down to the industry analysis, and then finally we do the company analysis. So now, for example, we have to analyze ITC. So now when we are talking about ITC, we are first of all talking about the economy as a whole. So when we are expecting that the economic growth rate is strong growth rate, Mr. Raghuram Ranjan in his monetary policy telling us that there would not be a rate cut because there is a high level of inflation. Maybe he is giving an idea that he might just cut the rates in the next session as the inflation levels are controlled. So we are talking about growth in the industry. So we are talking about the economic analysis, economic parameters. So when we are talking about ITC and we are talking about economic analysis, we might just get a good return if the economy is doing well, because ITC caters various other segments like hotels, like agriculture, like tobacco, and etc. So FMCG, ITC, a major player. So we are expecting a good return if there is a growth rate in the economy. Also, if there is a good monsoon, we can expect good return out of ITC because of the agri aspect of ITC. So now we are coming back to the industry analysis. So in industry analysis, we are talking about the demand and supply relations and the industry structure and competition. So for example, Patanjali coming in and telling that they will be launching say some product, FMCG product which ITC already caters. That might just bring the competition into the picture and they cut down the economics of scale. So that would affect ITC. So we are talking about industry analysis. And finally, when everything is good, we are talking about the company analysis. We are talking about ITC future and ITC quantitative factors, and also we are talking about the dividend distribution of ITC. So we are talking about the company analysis. So when we are talking about company analysis, it is very important to see different parameters of the company, what exactly we are doing in company analysis. So in that case, we will be taking care of the sales revenue growth rate. So for example, if ITC is earning say 10,000 crores is the sales for this particular year, FY, say in 2015, so we are expecting a growth rate. So we expect certain growth rate and the sales might increase. So we are investing as a shareholder, we are very beneficial for investing in a share which has a good growth rate in respect to the sales. Now we are talking about the profitability trend. So when we talk about the income statement, we are talking about sales. From that we deduct the cost of goods sold and we reach a stage called gross profit. From gross profit, we deduct all the expenses. So expenses may be the selling expense, or maybe the admin expense, or manufacturing expense. So these expenses will be deducted to reach to a stage where we get the Ebitda, earning before interest, tax, depreciation and amortization. So this becomes the operating profit of a company. From this operating profit, we kind of deduct the interest, tax and depreciation and amortization to reach the net profit of the company. So when we are talking about the profitability trend, we are talking about profit from operations as well as the net profit of the company. So as an analyst, when we analyze the trend of the business, we are very much concerned about the Ebitda margin of the company. So for example, the Ebitda margin of a company is say 10%, and last year it was approximately 12%. Even though the profit increased, profit after tax of the company increased, even then there is a concern that the Ebitda margin is going down. So that is the reason why we are talking about the profitability trend of the company in various parameters. Then we talk about the product line, the turnover or the age of the company. So when we talk about the product line, there might be a possibility that company has announced a product which is basically a competitor to an existing product. Existing product of the same company, then there might be an issue with respect to the two products. So it might be a scenario that the sales of the second product are going strong, but the sales of the first product might be coming down, which will impacting in the revenue of the company. We are also talking about the R&D budget. It happens mostly in the case of pharma shares that their R&D budget goes high, and because of that the R&D cost, the profitability trend decreases. We are talking about the pricing strategy. It has been observed that most of the products which are doing very well might not be priced accordingly. So that particular product, now the company will do two things. One, either they will increase the quantity sold of the product with respect to the price. So if they are offering a cheap price, they might be profitable only and only when they sell huge quantity of the same product. Or there might be like what happens in real estate, the pricing is too high, but they are very much beneficial even though they sell low quantity. So the pricing strategy should be appropriate. We are also talking about today about the patent and technology. So when we talk about the patents and technology, it happens mostly in the IT scenario. So the patents and technology will basically benefit a company which is already existent, or there might be a scenario that a small company coming out with a good patent which is getting a benefit. We are also talking about the organizational performance of the company. So effective application of company resource and efficient accomplishment of the company goal. So when we are talking about the management aspect of the company, we are talking about two things. One is the efficiency and other thing is the effectiveness. So company's management should work for a common goal. Effectively and efficiently. The management should work for a common goal effectively and efficiently, and hence management functions come to the picture. So management functions include planning, organizing, leading and controlling. So when we talk about the plans are the goal setting or resource setting. So organizing the basic plans is assigning task force to get in to basically reach those plans which are already there. And then there is leading. Leading is motivating the achievements. And last, controlling. Controlling is basically a check on all the accomplished elements of management. So when we are planning and then controlling means we are verifying what exactly the result is, or it is according to the plan, it is over and above what we planned, or maybe lacking something which should be controlled. So as we were discussing the fundamental analysis, so theoretically the fair value of a bond and equity share is the sum of discounted value of the expected future cash flows. So when we are talking about the bond valuation, we already know about the future cash flows. So we are expecting a coupon rate at 8%. That means every quarter or every annual annum we will be getting 8%. So say maybe quarter 3 you getting 8%, then you getting 8% in quarter 4 and then quarter 1 and so on. So you're getting 8%. So you already know the future cash flows. So it becomes very easy when we do bond valuation because we already know the future cash flows. The valuation is simple in bond because the cash flows are predefined and end at the point in a time. So there is a maturity value. So you at a particular time, say after 3 years, you'll get this much amount of the maturity value. So you already know the coupons and you're getting the maturity value also. So that is why the bond valuation becomes easy when with respect to the equity valuation. In case of equity earnings, the earnings are not predefined and equity is a perpetual investment. So with no preset maturity date, so there is no maturity date, the earnings are not predefined and hence there is a issue with respect to equity valuation. So we have to analyze the earnings, we have to estimate and anticipate the future earnings, and then we need to discount it, and then we do the equity valuation at a particular terminal value, or maybe the cost of equity or the growth rate, which we eventually the cost of equity, cost of debt, and cost of preferred dividend. We talk about this preferred share, and then we come to a WACC, and then we do the equity valuation. The focus of equity valuation is on the future earnings and estimated of growth in the earnings. So the whole focus of the equity valuation becomes the future earning, the future cash flows, and the estimates of growth of earnings. So according to fundamental analysis, as we already discussed, there is economic analysis, industry analysis, and company analysis. So when we talk about the top-down approach, fundamental analysis may be triggered by changing macroeconomic factors, both international and national, international and domestic, and such as GDP growth rate, inflation, interest rate, exchange rate. This can lead to an analysis of their impact on different industries. So these economic factors would lead to impact on different industries, as we have already spoken about this, and this is called the top-down approach to fundamental analysis. For example, regulatory uncertainty regarding spectrum auction in the telecom sector in India would trigger a relook at the industry's prospects and its impact on different companies in the sector. So recently we have the spectrum issue, that is an economic issue, and we have to cater, we have to take care of that economic changes coming into the industry analysis, the whole telecom industry analysis. And the listed companies in telecom space, we have only 3 big listed players in telecom space. One is Bharti Airtel, one we have Reliance Communication, and then we have Idea Cellular. So we have to see what would be the trigger of these changes on these different companies. So that time, that's where we are talking about the top-down approach. Now there is something called a bottoms-up approach. Sometimes analysis is triggered by some news or piece of information or some company which may move the industry analysis and then economic analysis. So these days this is very common. There is certain news which is discounted in the flash of a time, and in that case we are talking about the bottom-up approach. So there comes some news which is catering to a particular company, and then we see that the industry, it will be affecting the industry as a whole and then the economy. This is called the bottom-up approach of fundamental analysis. Technical analysis is basically based on the assumption that all information that can affect the performance of a stock, company, fundamental economic factor and market sentiment is reflected already in the stock prices. So when we are talking about the technical analysis, we are expecting that all this information which we are analyzing has already been discounted and reflected on the stock prices of the company. So accordingly, technical analysis do not care to analyze the fundamental of the business. Instead, the approach is to forecast the direction of prices through the study of pattern and historical market data, price and volume. So technicians believe that the market activity will generate indicators in the price trends that can be used to forecast the direction and magnitude of the stock price movement in the future. So technically we are talking about the demand and supply scenario. So for example, if a company is going strong with huge volumes, we technically take care of these demand and supply scenarios, and on the basis of chart we can give a research output whether to buy, sell or hold that particular commodity or a asset. There are 3 essential elements in understanding the price behavior. The history of the past prices provided indication the underlying trend and its direction. So for example, a past price may be, in case of technical analysis, the dotted lines are the prices of this particular asset. So the history of the past price will give you a brief idea about how the stock might move in the coming future. The volume of trading that a company's price movement provide important inputs on the underlying strength of the trend. So the volume with respect to the upward price, there is a volume also. So the volume might give a understanding as to whether the prices moving up are actually on good volumes or not, and this will also clear whether we should get into the basic buy scenario or not. The time span over which price and volume are observed factor in the impact of long-term factors that influence price over a period of time. So now there are three issues. One, we have to see the past prices, then comes the volume and also the time span accordingly. Economic analysis. Economics is the study of how people make choices under condition of scarcity, basically, and the impact of those choices for people at an individual level or society or a macro level. So these are basically dependent on the various assumptions. So when we are talking about the national income is an income defined through a variety of measures such as gross domestic product or gross national product. So we talk about the GDP and the GNP. Computation of this number is humongous task in terms of data collection. It's a very huge task. So for example, a company which for example Reliance is also contributing to the GDP of India, ITC is contributing to GDP of India. So it becomes a huge task to collect this data and basically do the analysis on the same. So there are certain methods. Now of the economy can be measured through three methods. The three methods are product method, income method and expenditure method. So broadly stating, the national income can be measured in these particular three methods. So we will tackle them one by one. First comes the product method. In this method, the national income measured as an aggregate flow of goods and services in the economy from different sectors. So different sectors like agriculture sector, industry and services. Economists calculate money value of all final goods and services produced in the economy during a specified period of time. Final goods refers to only those goods which are consumed by economy participants and not ones used for the production process intermediate. So these are the goods which are these are the goods which refer only to those goods which are consumed by economic participants. In this method, the national income is measured as an aggregate income. In the previous method, we have seen the national income measured as an aggregate flow of goods and services. Now in this method, we measure it as an aggregate income of individual in the economy. So Robert Kiyosaki, an author and businessman, divide the whole working population in the world in four broad categories. Employees, that is labor and other employees, professional, entrepreneur and investor. So we are talking about here as an aggregate income of individual in the economy. Now the other method is expenditure method. Expenditure method attempt to undertake the same philosophy while computing the national income. Consumer in an economy are broadly divided into categories like the previous method: individual, corporate and government. The aggregate demand of goods and services is computed as sum of private consumption, government spending and gross capital formation and net of export, like the income method. So when we are talking about inflation, inflation is a uniform rise in prices. So when we are talking about the monetary policy, in case of monetary policy, the governor makes certain changes. The governor makes certain changes like increase of the rates or decrease of the rates, or maybe the status quo approach. Status quo means there is no change, either increase or decrease. So in case of monetary policy, all these decisions are based on the inflation trends in the economy. So when we are talking about inflation, inflation is defined as the general increase in the price level of goods and services. So it is a general increase in the price level of goods and services in the economy, leading to an erosion of purchasing power of money. For example, if there is an increase in price and services, one might buy say 10 kg of potato for 100 rupees. Now because of inflation he might be able to buy only 8 kgs of potato at 100 rupees. So there is a general increase which will impact generally to every individual. So inflation can be caused by demand pull factor or cost push factor. an increase in the price of goods and services because demand being in excess of available supply is called demand pull factor. This means if the demand is increased and there is not enough of supply for that particular good, that is a demand pull factor. And then comes the increase in price because of an increase of input cost is called the cost inflation factor. So there might be a scenario that a particular product has some raw materials going into the finished product, and hence the raw material cost has increased, and this will increase further the product's price. That would be the cost push inflation. To diffuse the inflation policy, market makers adopt several measures to reduce the demand or increase the supply of both. So the market makers might increase the increase the quantity demanded or decrease the supply, and then increase and supply, they will eventually impact the inflation trends. Interest and inflation are closely linked parameter. Higher inflation demands higher rate for people to get motivated and save. So when we talk about inflationary trends, there is a high chance that in case of high inflation, people might not invest more or consume more. So people might not buy more products. And hence what happens is the saving part increases. Hence that is the reason when the rates are decreased, the inflation increases, because people will now buy more and people will buy more because the banks might be able to lend more. And hence what happens when there is over money supply in the market, growth becomes, there is a growth rate coming into the picture with high inflation. So hence if there is a high inflation, Mr. Governor might just increase the rate so that banks might not able to lend more, and hence eventually people might not be able to consume more. And when they don't make any investments or consumptions, there might be a scenario that they are saving more, and hence the inflation coming down. As they save more, the consume less, consumption goes down. On the other hand, higher rates reduces the investment. High cost of capital may slow down the overall economy. So that is what I was telling. If there is higher rate of inflation, it might cause slowdown in the economy. The higher rate affects some sectors such as real estate and auto more intensely, as most of the buying here by middle class people happens through loans. So that's what I was discussing. If there is high rate of rates available in the market, people might not lend, banks might not lend more, and hence it might affect certain sectors called auto sector or maybe the real estate sector, where people kind of lend more, people kind of take more loans to buy auto and real estate. Higher inflation reduces the discretionary income. Discretionary income that people have and impact their demand for products and services across the board. So higher inflation will reduce the discretionary income which people already have, and their demand for product and service according. So when we talk about fundamental analysis, we make a lot of strategies, and for those strategies we have to analyze the situation past, present and future. For this purpose we make strategies with Pestle analysis, the BCG matrix and SWOT analysis, the most common and known strategies. Pestle analysis. When we talk about Pestle analysis, Pestle stands for political, economical, social, cultural, technological, legal and environmental analysis. Some models also extend this to include ethics and demographics, and that is called steepled analysis. So when we talk about the various strategies, we talk about Pestle, steepled, BCG and SWOT analysis. The most prominently used analysis when we are making a fundamental report becomes BCG as well as SWOT analysis. But we also take care of the Pestle and steepled analysis. So when we are talking about the demographic front, we are talking about the steepled analysis, and when we're talking about economical, social and technological, legal and environmental analysis, we are talking about the PESEL analysis. Right. So analysis is done more from the perspective of business which is looking to set up unit offshore and analyzing several countries to choose from. This model primarily analyzes the external environmental factor. So when we are talking about the external environmental factor, we are talking about the PESEL analysis. Now we will come down to the BCG analysis. The full form of BCG is Boston Consulting Group matrix. So when we talk about this matrix, we talk about two parameters. One, the market growth rate, and second, the market share. So market growth rate and market share are taken on the X and the Y axis, and relatively we talk about the companies falling into stars, question mark, cash cows and dogs. So when we talk about dogs, we talk about low market share and high market growth rate. So when we talk about the BCG analysis, we talk about the relative market share, cash generation worth and the market growth rate, that is cash usage. So when we talk about the cash of the company, we talk about the market growth rate of this cash plus the market share of the cash which the company has. So the BCG matrix would include four dimensions of the matrix. One, the stars, question mark, dogs and cash cows. So if we talk about cash cows, for example, we are talking about high relative market share with respect to low market growth. But that doesn't mean that the low market growth will not be a high market growth in the near future. So we are talking about companies which have high market share plus they are ready to have a high market growth as well. So that's why we talk about cash cows. So companies already having a high market share and will finally move into the stars, that is high market growth as well. But when we talk about the dogs are the companies with low market growth plus low market share. So these are the companies which are basically into a very deep trouble, or maybe which are to be looked upon. So when we talk about dogs, these are the companies which are sick in nature. So this company would be having a low growth rate plus a low market share, relative market share. Now when we talk about the question mark are the companies which are already at a high growth rate, but the companies which have low market share. So because of some reason the market share is quite low, but the growth rate is quite high. Even the question mark are better than dogs. So when we talk about this matrix, cash cow is the company which are growing companies, which already have a high market share and will grow in coming future. But then when we talk about the stars are the companies which have high relative market share plus high relative growth rate. So these are the companies which are best among the lot. So these are the companies which are available at a high PE multiple. So already the companies have a high growth rate plus it already has a high market share. So the companies have already fallen into a saturation point. So we can't expect much from the stars as already they have delivered the performance. But we can expect much from cash cows as they are likely to become the next stars. When we talk about dogs, it is very necessary for dogs to enter all the other zone so that they can become a revenue generating unit, a cash rich company. So when we talk about the BCG, let's go to the theory first. Stars, these are the segments in a business where market is growing rapidly. As we have already spoken about, stars are the segment where market is growing on rapidly and companies having a large market share. So when we're talking about the market share, it has a large market share. This segment generates increasing cash for the business with the passage of time. For example, Cera Sanitary Ware could be a good example of stars with large market share, continuous growth and significant cash rich company. So a company called Cera Sanitary Ware is a good example of star because it has a high market share and significant cash rich company. When we talk about the cash cows are the companies which have low market growth but high market share. So these are the companies which require low cash infusion for investment to maintain market share because of low growth prospects, but at the same time steadily generate cash for the company from established market share. So for example, companies called like Navneet Publication, which is into the business of books and notebook, could be a good example of cash cows. The industry growth are predictable and steady rate each year. So for example, the industry which Navneet falls into is publication. Now this has a steady industry growth and a predictable industry growth each year, and that is the reason why this company is falling into low growth rate and high market share. Now we talk about the question mark business segment in a fast growing market but having a low market share. So unlike the cash cows, it has a low market share. Right strategy and investment can help the market share of the business to grow. So one should have a right strategy to implement so that it can grow his market share in the coming days. But they also run a risk of consuming cash in the process of increasing market share, and in the end out to be not enough cash generating. So for example, Tata launched Tata Nano. Tata Nano can be a good example of this particular question mark which did not. So Tata Nano, when we talk about Tata Nano falls into the question mark category where the market share is low but the growth rate was high, but they could not implement that particular growth rate, and hence Tata Nano which did not succeed, whereas Bajaj Pulsar may be considered an example of question mark which succeeded. So the right strategy was implemented in the case of Bajaj and they succeeded, but the right strategy might not have helped Tata Nano to succeed. So that is the reason why when you are into a question mark phase, the company is into a product into the question mark phase, then we have to implement the right kind of strategy to gain a high market share. Now comes the dog business segment which have slow growth rate and intensive competitive dynamics which lead to low generation of cash and categorized as dog. They have a high rate of competition and that is the reason they are categorized as dogs. So when we talk about dogs, it has low market share and low growth rate. The next analysis is the SWOT analysis. The SWOT analysis, as we have already discussed, stands for strength, weakness, opportunities and threat analysis. So when we are talking about the SWOT analysis, whenever we make a report, it is very important to create a SWOT analysis. So SWOT is the strength of the companies plus the weakness of the companies, the opportunities of the companies and eventually the threat of the companies. So there is a problem that we kind of think that weakness and threat are the same thing. Threat and weakness is a different thing. Threat would be coming in the future. Weakness is something which company possesses today. So when we are talking about strength, weakness, opportunities and threat, opportunities is something which is coming in the future, strength is something which the company has today. Like that, threat is something which will coming in the future and weakness is something which the company possesses today. So the four elements of SWOT analysis become strength of the company, weakness of the company, opportunities of the companies, and finally threat from other companies. So when we talk about the strength of the company might be a company which is having a exponential or a very big market share in a particular region becomes the strength of the company. Or for example, a company which has a very strong product, or maybe a pharma company which is launching a drug which has a monopoly, in which no other company is having the company is not having any competition, that becomes the strength of the company. Likely the weakness of the company may be a company which has a lot of product and the company is very diversified, and they are not taking care of their diversification. Maybe they are getting loss in a particular unit, a particular sector, business unit, and profit in another business unit. But when we talk about the consolidated effect, there might be ending up getting losses. So that becomes the weakness of the company. The weakness of the company may be a company which is into automobile manufacturing and is not having a solid product as compared to its peers, become a weakness of the company, as hence the company might not be able to fetch as much revenue as they already expected in last year. So that becomes the weakness of the company. And when we talk about the opportunities, maybe a company which is into, say, certain domain is expecting some government, for example, a bank expecting that the rate might get increased so that they can lend more, become the opportunities of that particular sector. Likely threat of a company, threat becomes, for example, two companies are manufacturing the same product, like for example Patanjali and HUL manufacturing the hair oil, or maybe Marico, Dabur and Patanjali, three of the companies manufacturing hair oil. Entry of Patanjali into hair oil business become threat for HUL, Dabur and Marico. So that is the threat of the company. So when we are doing a fundamental analysis, we are pretty sure of the qualitative aspect. And when we are talking about the qualitative aspect, SWOT analysis becomes the more prominent and widely used analysis. So every business has its own strength, weakness. It is good for the analyst to clearly understand and document both of these to have a clear picture of the situation. Similarly, opportunities to the business or potential risk to the business can be documented by the analyst in the form of opportunities and threat. In a way, SWOT analysis is nothing but a way of documenting strength, weakness, opportunities and threat at one place in a concise manner. So when we are talking about a report, when we are making a report, an investor would be able to go through the SWOT analysis and take his own decision. So he will get a concise manner, a one pager of SWOT analysis of that particular company. Now other factors to be considered when we are talking about the quality of the management, including independent director and governance, pricing power and sustainability of the power, organizational structure, critical business delivery and compliance orientation of the company. So when we are talking about the sectoral analysis, we clearly have certain sectors which have certain elements which are very common to every sector. For example, when we are talking about the key industry driver, when we take the telecom sector, it has not, the market share is held upon three major companies, that is Bharti Airtel, Idea, and when we talk about the pan-India presence, RCom. Vodafone is not a listed entity and hence we will not take that into the picture. So when we talk about the market share, primarily there are three major companies, Bharti Airtel, RCom and Idea. So when we are talking about the industry driver, so if we take telecom, average revenue per unit becomes very important. So a key parameter by analyzing this sector is the average revenue per unit, that is the ARPU. It is calculated by total revenue divided by number of subscribers. So total revenue, ARPU is calculated by total revenue divided by number of subscribers. So as it says total revenue, so when we talk about the ARPU, the more the better. So the more ARPU, the better it is. So hence, when we're talking about the three companies, when we're talking about telecom sector, industry analysis, we are talking about the ARPUs of the companies, and hence we will do a relative valuation where we will compare ARPU of Idea with ARPU of Bharti Airtel with ARPU of RCom, and eventually we'll take the decision. I mean, this would not be a decision taking factor, but this would be considered. So it must be noted that India has among the lowest ARPU in the world. So this becomes an irony. India has among the largest populations of the world. There are so many users, but the ARPU are the lowest among the world. Other parameters like mobile penetration and spectrum cost. For example, recently we have a spectrum bid. So spectrum costs are also very important for telecom sector. So when we talk about similarly for IT, BPO and KPO sector, we talk about the currency. So when we talk about IT sector, we are talking about the currency fluctuations. When we are talking about the IT sector, we are talking about the currency fluctuations. So for example, India is a import oriented economy. We import more than we export, and hence when we are talking about IT sector, India grew primarily due to a large available pool of English speaking young talent at a low cost. So IT companies earned in dollar and spent in rupees. So when we are talking about the import oriented economies, we are benefiting when the currency, the domestic currency, in case of India, that is rupee to be gaining strength. So when we are talking about the import oriented economy, we are talking about domestic currency gaining strength. So that is very important for us. If the domestic currency is gaining strength, then we are getting when we are getting more money, and hence we are gaining in this case. For example, a export oriented economy, when we are talking about export oriented, then we are talking about the dollar gaining strength, and hence eventually we are talking about the domestic currency to fall. So because we are getting in dollar terms, hence we are expecting the domestic currency to fall in near future, and hence we are gaining out of it. So there are two parameters. When we are talking about import oriented, we are talking about rupee to appreciate, that means the domestic currency to appreciate, and when we are talking about export oriented economy, we are talking about rupee to go down, for example, or domestic currency to go down. So even today, the USD INR rate, attrition rate among employees, concentration of revenue with selected clients, concentration of geography, etc. are important parameters to watch for. One more thing to watch for in case of IT companies is the geographical parameters. The company like Infosys or maybe TCS, or maybe Tech Mahindra, they export a lot, and hence we are talking about the geography of the export. So we will also look into the parameter side, right? For example, they are exporting more to North America, or maybe they are exporting more to Europe. So if suppose, for example, if there is a Greece issue coming into the picture in near future, the Europe is in more trouble, and the companies which are exporting their product to Europe, those stocks might just go down, and hence we are looking forward for these parameters as also, like the demography. So as we have discussed about the geographies, let's take a look from where to fetch this particular data. So when we are talking about the IT company, we shall go and look upon major IT companies data. So when we talk about the market share, there are 2-3 companies which have a huge market share when we talk about the IT companies. So one would be Infosys, other would be TCS, and other would be Tech Mahindra, maybe Wipro. So let's take out Infosys data. So as I have told before, we'll go to the BSE site, bseindia.com. And as the page appears, we'll go and write Infosys in the security name. When we search for Infosys, we'll be able to see the price of the company, but we are concerned more about the disclosures of the company. So we'll go to the news part and we'll click more. So when we click more, we'll get the disclosure of the company. So we are concerned about this particular data of the company, and hence we'll go and look for the fact sheet presented by the Infosys company, or else we can go and open the consolidated or maybe standalone results of the company. So when we click on the PDF file, we'll be able to see the fact sheet of the company. So in the fact sheet of the company, Infosys has presented the income statement of the company. So when we are talking about the income statement of the company, the income and expenses and the profit would be declared in this particular statement. So first we have to check whether in which unit the company has presented the income statement. So the unit is crore. So the revenue for this March quarter 2016 is 16,550 crore. It was approximately 13,400 crore in 2015. So they have shown the growth accordingly. So this becomes the year-on-year growth. So year-on-year growth is 23.4%. So when we see, if we have to compare the same revenue with the last quarter growth, the last quarter it was 15,900 crore. That is December 31st, 2015. And the last quarter growth is 4.1%. So as I have told before, there are 4 quarters. So 4 quarters taken together will make a annual statement. So this first quarter is the June quarter. The June quarter means the quarter from April till April, May and June. Next becomes the September quarter, then becomes the December quarter, and then the March quarter. So December quarter is the quarter 3 and March quarter is quarter 4. So when we talk about the half-yearly scenario, we are talking about first half of the company and the second half. So first half and second half taken together would be the annual performance. So when we are talking about big companies, we are very much inclined towards the performance of first half and the second half. So there are companies which perform better in second half and there are companies which perform better in first half. So when we talk about the half-yearly statement, in this case also we are comparing this statement with the last half of previous year. So if suppose the half year of 2016 would be compared to half year of first half of 2015. So hence in this particular statement they have shown the performance of March 31st 2016. So March 31st becomes the quarter 4, and which is being compared to the last year same quarter, that is March 31st 2015. So this is year on year growth rate, and if it compares with the quarter 3, that is December 31st 2015, becomes the quarter on quarter growth rate. So when we talk about Infosys, the revenue for March quarter was 16,515, which was up 23% year on year and up 4% quarter on quarter. Similarly, the gross profit of the company was up 20% year on year and up 6.4% quarter on quarter. When we talk about the expenses were also up 15% year on year and were up approximately 6% quarter on quarter. So like we have told before, when we deduct expenses from the revenue, we get the operating profit. That we are talking about the EBITDA here. So EBITDA is approximately 22% of growth year on year 6% up quarter on quarter. Finally, we arrive at the net profit. Net profit is 3,597 crore, which is up 16% year on year and 3% quarter on quarter. So now, after the net profit, when we divide this particular figure with the equity and multiply by face value, we get the basic and the diluted EPS. Approximately 15.74, again which is up 16% year on year and 4% approximately quarter on quarter. So now, as I've told before, these are the quarterly performances, and now when we add all the 4 quarters, we get the annual statement. So annual statement is given for this Infosys because the quarter 4 results have recently been announced, and hence when we talk about the annual statement, it shows that the Infosys has generated a revenue of 62,400 odd crores, which is up again 17% year on year. And when we talk about the operating profit, it is up approximately 13% year on year with 15,620 crore. Similarly, the net profit is up 10% year, approximately 9.5% year on year with 13,491 crores. Similarly, even if we add the 4 quarter EPS, or we can also take out the EPS as profit by equity into face value, that is approximately 59. So as we have discussed before, there is something called the standalone and consolidated. So this performance is based on the consolidated facts. So now, as we were discussing the key dimensions of industry, when we are discussing the geographies, here we can see the geographies of the same. So when we are talking about Infosys, so the whole market, if we talk about the revenue by geographical segment, the market share, so approximately 61.9% revenue of Infosys is coming from North America. Last quarter it was 62.5%, and last year same quarter it was 62.8%. So when we see this, the revenue from North America has slightly decreased when we are talking about Infosys specifically. But when we talk about the year end, the annual revenue from North America, it is slightly increased rate at 62.7 and 61.5. So similarly, Europe, from Europe Infosys is able to fetch a revenue of 23.4%, which is approximately same as that of last quarters. From India, Infosys was able to fetch a revenue of only 3%. So when we talk about Infosys, the revenue from India is only 3%, and it was 2.8% in December quarter. And rest of the world, the revenue is 11.7%. So clearly we are talking about the whole revenue of Infosys, the major revenue Infosys coming from 2 regions, that is, one is North America and other one is Europe. Approximately 84% of revenue coming from Europe and North America. So if suppose there is a something, I mean, if suppose Greece exit happens, or maybe there is some recessionary environment in North America and Europe, there might be a situation when the company stock might come down, because 84% of revenue, odd revenue is coming from these 2 regions. Now they have clearly mentioned the service offerings. So when we talk about the service offerings, business IT services getting a 61.9% revenue of the total. So when we're talking about the total revenue, 61% is coming from the business and IT services. Similarly, consulting services is able to get a revenue of 33%. Hence, if we talk about the domain from which the revenue is coming, the biggest domain for revenue is application development and application maintenance. So when we talk about both of these, 33% odd revenue is coming from both the domains, and hence 33% is coming from consulting and packaging activities. The BPO division of this business process management division of Infosys is fetching only approximately 5% of the revenue, and testing is fetching around 9% of the revenue. So this is how we can fetch the data. So when we talk about the revenue from project type, time and material consuming of 54.9% revenue, and fixed price It's coming around 45% revenue. Now this is also very important. We are talking about the industry which is able to produce how much revenue. So when we are talking about the BFSI segment, the banking and financial service insurance segment, Infosys is fetching approximately 32.8% revenue from this particular segment this quarter, and last quarter it was fetching approximately 33.5% revenue. So the performance from business, banking and financial services and insurance domain has come down from last quarter. Similarly, if you talk about the breakage, insurance was coming down slightly, and so is the banking financial services domain. So banking financial services domain is again very important for Infosys fetching around 27.4% revenue. If we talk about the manufacturing and high tech, it is fetching around 22% revenue, and retail and life sciences, majorly retail and CPG taking around 24.5% revenue, retail approximately 15% revenue. So when we talk about again the other units, that is telecom, energy and utility, it is fetching around approximately 13 to 14% of revenue. So when we talk about big IT firms, it is very important to see how much the client is giving money to this particular firm. So when we talk about the orders, we are talking about the biggest client orders and the active client orders. So approximately Infosys has 1092 active client order this quarter. So when we talk about this active client order, this is same as the year end. So year end also 1092 clients were active. But we have to see how much those clients are contributing. So when we talk about $1 million plus clients, there are approximately 558 clients which are $1 million plus. But when we are talking about $300 million, that is a huge amount. So they have approximately one client who is $300 million plus, and approximately 268 clients who are $5 million plus. So they have good top clients. So top client contributing around 3.6% of the revenue, and top 5 clients contributing around 13.7% of the revenue. So this figure is very important. The repeat business of Infosys is around 95.8%, which is quite high. I mean 97% annually Infosys is getting the repeat business. That means if a client is giving business to Infosys, they are repeating it 97% of the time, which is a very good thing. See employee metrics as well. So attrition is very important for a company. I mean, if they can control the attrition rate, that is very good for a company. So Infosys was able to control the attrition, as that was 8,620 in number in December 31st, 2015, that is quarter 3, which has been reduced to 8,373 in March 31st, 2016, that is quarter 4. If we talk about the year-end performance, the attrition figure was 37,000 odd numbers, and it is approximately 34,600 odd numbers. So Infosys was able to not only to control but to decrease the attrition rate also. So when we talk about the attrition percentage, if we talk about the consolidated attrition, that is taking all the client, taking all the subsidiaries, it was approximately 18.1% in December quarter, which has been reduced to 17.3% in March quarter. So when we talk about the attrition rate, whole annual attrition rate was decreased from 22.3% to only 18.7% this year, which is a very good thing. So again, the whole statement they have given on highlights. So Q4 revenue growth at 1.6% quarter on quarter in USD terms, and in constant currency terms it is 1.9%. Again, they have given that the Q4 operating margin at 25%, increase of 0.6% from quarter 3, and operating margin of 24.9%. So FY17 revenue guidance, again there is a term called revenue guidance. The company was able to give a revenue guidance. So when we talk about the revenue guidance, majorly the big IT players give certain revenue guidance to give a approximate growth rate to the industry. So Infosys has given a revenue guidance of 11.5 to 13.5% in constant currency and 11.8 to 13.8% in USD terms. So they have given a revenue guidance, that is they will be increasing at a rate of 11.5 to 13.5% in constant currency terms, and will be increasing at a rate of 11.8 to 13.8% in USD terms in March 13, 2016. So this is compared to the NASSCOM figures. The NASSCOM publishes revenue guidance or industry growth rate of a industry, and all the major players gave their own revenue guidance, and we are very much concerned about the fact whether they are able to beat the revenue guidance of NASSCOM or not. So as we have seen in the case of IT sector, we'll be talking about the banking, NBFC and housing sector. So the monetary policy by RBI is the single largest impacting factor to this sector. So RBI rate hike or maybe the RBI rate cut will affect the sector as a whole. So we have seen that whenever the monetary policy is there, the banking stocks are quite volatile with respect to the interest rate cut hike or maybe the cut. So when we are talking about the interest rate hike or cut, we are also talking about the NPA levels of the company. NPA level, provisioning norms, tight and loose regulatory reserve requirement all impact banks and NBFCs. So there are certain rates like repo rate, the reverse repo rate, CRR rate, approximately which is 4%, SLR rate. These rates will impact the bank and eventually the shareholders. So when we talk about banking sector, let's go and look the banking sector income statement, and we will be able to relate more to the things. So similarly, like IT sector, we'll go to the BSC, we'll type down HDFC Bank or maybe any other bank. I am taking the HDFC Bank. So we'll be able to go to the news section. We'll look for the quarter 4 income statement or maybe the results. So here it is, announces quarter 4 FY16 results, standalone as well as consolidated. So we'll open the PDF file, and once we have opened the PDF file, we will look for the income statement. So we here clearly see the financial results of quarter and year ended March 31st, 2016. So in case of bank, what would be the net sale? Net sale would be the interest earned. I mean, they have given some loan to various people, various banks, various corporates and other firms, and the interest earned upon those loan would be the interest earned. So interest earned is more or less equal to the sales of the company, of the bank. So here we can see the interest earned is approximately, this figure is in lakhs, so the interest earned is approximately 15,996 crore, which is good. If you see the last quarter, the interest earned was approximately 15,411 crore. So they have earned a fair bit of interest this quarter also. Similarly, like the IT, we have also seen here that we have to see here the full year results have been shown here. So this is pretty much 60,221 crore with respect to 48,469 crore, which is a very good jump. So the total interest earned is good. Now we will also look into the other parts. Let's go to the net profit. Net profit of the bank was approximately 3,374 crore with respect to 2,806 crore last year. So in case of yearly, the profit of the bank was approximately 12,296 crore, increased from 10,215 crore last year. So now we are talking about the NPS, where to find the NPS. So in the income statement itself, every bank shows their the NPA ratios. So if we talk about the NPA ratios, there are gross as well as net NPA. So the full amount is given for the NPA plus the percentage part is also given. So if we look at the percentage, the NPA for HDFC Bank, the gross NPA is approximately 0.94% with respect to 0.97% last quarter and 0.93% last year. So if we see the NPA has reduced on quarter-on-quarter basis, whereas slightly increased when we talk about the year-on-year NPA. But when we talk about the net NPA has reduced again on quarter-on-quarter basis, slightly increased on year-on-year basis. So the total NPA, the amount is approximately 4,392 crore versus 33,438 crore. So the NPA is the amount which has not been recovered from the loans they have given. So that is the amount which is basically NPA, and NPA has slightly reduced, which is a good thing. On quarter-on-quarter basis, the NPA has reduced, which is a good thing. So in case of HDFC Bank, this is a good thing. But similarly, if we talk about maybe a PSU bank, we will observe that the NPA has not only increased, but is very high when compared to a private sector bank. So we can see maybe we'll talk about maybe PNB. So Punjab National Bank. Let's see valuations of Punjab National Bank. So again we will look at the consolidated and standalone quarter 4 FY16 figures here, and we will open this file. So here it is. So when we see when we compare this, the interest earned has reduced. For HDFC it has increased, but in case of PNB it is also in lakhs, so it is approximately 10,800 crore. It was approximately 12,200 crore last quarter, so it has decreased. The interest rate has been decreased, which is not a very good sign. Again, if we go to the profit, in fact the bank has given a loss of approximately 7,257 crore. It was a loss in last quarter also, but the loss was approximately 857 crore. This time the loss has increased terribly, and if we compare this figure to the last year performance, we'll see the loss has increased from the last year itself. I mean, it was just 631 crore. So this loss would be because of some item. Let's go and find that particular item, and if we see the expenses, total expenditure has also increased. If we talk about, so it is approximately, so the loss has increased terribly, and we have to look on the factor why the loss has increased. So when we talk about the expenditure is pretty same. It is approximately 10,048 crore versus 10,973 crore. So approximately the expenditure has been same. In fact, the expenditure has reduced. So what is the reason of this loss is the provisions been made, provision and contingencies. So when we talk about the provision and contingencies, it is approximately 10,485 crore with respect to only 3,775 crore last quarter. So this is the reason. The extra provision made is the reason of the losses. So we have to go and check why these provisions, the extra provision has been made. So we'll go look at that later. But if we see the net profit has increased drastically to the loss has increased drastically to 5,367 crore versus only 51, the profit of 51 crore last quarter. So now we'll go and see the NPA ratios of PNB. If we talk about the NPA, so we can see the amount of gross non-performing assets is approximately 55,818 crore versus only 25,694 crore in the last year. So NPA has increased at an increasing rate, and if we talk about the net non-performing net NPA, it is also 5,422 crore. So here we can see that the percentage of the NPA, net percentage of gross NPA is approximately 12.90%. So when we talk about the HDFC Bank, the net NPA was, gross NPA was approximately 0.94%, and in case of PNB it is mammothly 12.90%, and even the net NPA is 8.6%. So this is when we talk about the PSU Bank, the NPA is quite high because they have given loans to some companies which have not given the interest and the loan amount back, so the NPA is quite high. So this is how we can see the NPA and the other provisioning figures of banking and other stocks. So let us now go to the media stocks. When we talk about media company, it depends upon the content, hence the company generating its own content will have an advantage over other. So company which is generating their own content would be having a definite advantage. So again, this particular term is very common when we are talking about the serial. The television rating points are the most widely tracked indicator in electronic media. So for every industry we have certain things which are widely tracked, and these tracking indicators will give a brief idea about the sector as a whole. So we have spoken about like telecom sector, IT sector, banking and media sector. Like these only, there is an aviation sector which is purely dependent upon the crude prices, the white petrol prices. Likely there is a sector, tire sector which is also dependent upon the crude prices, because crude is used in the tire they make. So the crude becomes a very big raw material for the tire industry. So likely we will see different indicators for different sectors. So now we'll be talking about the P&L, the balance sheet and the cash flows. So when we are talking about P&L, balance sheet and the cash flows, we are not talking about the qualitative aspect of company valuation, we are talking about the quantitative aspect of the company valuation. So when we are talking about the quantitative aspect, quantitative company analysis. So as I have told before, the P&L or the income statement is divided into few parts. So we'll start with net sales. So net sales of the company will just deduct the cost of goods sold from the company and we'll get the gross profit of the company. Gross profit, also called GP. From this we'll deduct all the expenses. So expenses would be admin expense, it would be selling expense, maybe manufacturing expense. From this we'll deduct, from this gross profit we'll deduct the expenses and we'll get the EBITDA or the operating profit. EBITDA is basically earning before interest, tax, depreciation and amortization. So we will deduct all these items now. So we will deduct interest cost, interest or the finance cost. Then we will deduct the taxes, we will deduct the depreciation, and we will get the profit after tax. In between we will get a figure called the exceptional item, that would be a one-time item. This may be a loss or a profit. So in case if it is a profit, then we will add this to the PAT and then we will get the reported PAT, or in case this is loss, we will deduct it from this particular item to get the reported PAT. After this, we will get the EPS of this company. The EPS is nothing but the profit upon equity into face value. So we will get the EPS of the company after coming down to the PAT. So when we talk about the profit and loss statement, it is a document which contains information on this revenue. Revenue is this part, the cost is this part, and the profitability of a firm for any given period of time. So one is the revenue aspect, again the cost aspect, and the profitability aspect at any given period of time. The financial results are published each quarter by the companies, hence we get quarterly P&L statement. As I have told before, we will get 4 P&L statement for 4 different quarters. That is quarter 1, quarter 2, quarter 3 and quarter 4. This would be combined together to get the annual statements. The net sales, this is the income which the company generates by selling its goods and services. All indirect taxes such as excise duty, value added, service tax have to be deducted from the gross sales to get the net sales. So before this we have a figure called the gross sales. Now we will deduct all these items to get the net sales of the company. Figure as these taxes are collected by the business for the government and don't belong to the business. So obviously these are collected for the business. Now one more item there is called other income. The other income sometimes will be added back to the net sales, and there is an item given called the total sales. Even in this case, we will ignore the other income unless and until this is coming out of operations. We will ignore this part and we will take the net sales, because we are more concerned about the operation aspects rather than any other income coming from anywhere else. So for example, if a company is into, if a company is a pharma company and it sells down a unit and it is getting other income by selling that unit and added back to the net sales so that it shows an increased profit, that would be irrelevant. So we will just ignore the other income part and we will only take the net sales. Or maybe there is a possibility that the profit of a company is down, or maybe the company is giving a loss only because there is a exceptional loss, a one-time item here. So also we will see what that exceptional loss is coming out of from, and we will ignore that. So we will ignore the exceptional loss or profit, and we will also ignore the other income unless and until they are coming out of the operations of the company. So when we are talking about the income statement, the other major parameter to talk about is direct cost. These are the costs which can be attributed directly to the business. Example of this type of costs are raw materials. So raw material cost will be included in these costs. So when we are talking about the cost of the business, we are talking about the raw materials. So raw material, as I have told before, that for example, if the company is taken is an aviation company, then we will be talking about the white petrol cost. If the company is a tire company, we are talking about the crude, which is again the raw material. If might be a possibility a company is a fertilizer company, then there is a option that they are getting a raw material which is bit costly to improve the product, so that would be a raw material cost. So these the electrical costs are also the direct cost, and others. Reducing operating costs will translate into higher profitability. So obviously the main purpose of the company is to reduce this particular cost so that the EBITDA is high and the profitability of the company is high. Cost may be variable such as raw material, semi-variable such as employee cost, or fixed such as plant and machinery. So certain costs are variable cost such as the raw material, semi-variable such as employee cost, and then there are fixed costs such as plant and machinery, which all are added in these particular costs. So certain costs the variable and the semi-variable cost may be played upon to increase or maybe to increase or decrease the profitability scenario of a business. So why would a company would decrease the profit? That is only because they have to pay less taxes. So earning before interest, tax, depreciation, amortization is what we call the operating profit, that is the EBITDA, which is very prominent when we are doing analysis. This is the difference between net sales of the company and the direct cost. We will finally reach the EBITDA figure. So we will talk about EBITDA margin and margins of other profitability index also. But when we are talking about the EBITDA figure, we are actually concerned whether the EBITDA is rising or not. So we are concerned whether the EBITDA to sales is rising or not. So for example, a company is operating at a sales of 100 crore and arrive at a EBITDA of 10 crore. And again next year the company is operating at a profit of 120 crore, but the EBITDA this time is only 11 crore. So obviously the EBITDA has increased, but the sales has increased more than the incremental EBITDA. So here the performance is good, but we are expecting more out of it. So when we are adding 20 crores in sales, we should add good amount in EBITDA as well. So here may be the possibility these extra 20 crore is because of high direct cost which is affecting the EBITDA margin here. So hence we are more concerned about the EBITDA with respect to the sales. As we have discussed the EBITDA, let's go and discuss the EBITDA margin. So this is a ratio which calculates the EBITDA as a percentage of net sales. So when we are talking about EBITDA, we are talking about EBITDA margin as well. EBITDA margin is nothing but EBITDA upon net sales. So if I talk about EBITDA in absolute terms, it will not make any sense. If I say EBITDA of 100 crore will not make any sense. But when I talk about EBITDA in percentage terms, absolute number make it impossible to compare. When we compare this with some other item, it is not possible to compare. But when converted into percent, comparison can be done very easily. So if I say EBITDA to net sales is 10% with respect to 8% before, that means the EBITDA has increased, which finally means the operating margin, operating profit has increased and operating margin have increased. So higher EBITDA, better for the firm. So we are much more concerned about the EBITDA margin rather than only net sales. So for example, if I say a net sale of 100 crore is getting a EBITDA of 10 crore, and similarly the next year the company gives a sale of 120 crore with the EBITDA of say approximately 11 crore. So although 11 crore EBITDA is good when compared to 10 crore, but when we see the EBITDA margin have reduced. That means for this extra 20 crore of revenue, the company must have undertaken a higher direct cost or expense to get this extra 20 crore, and hence which have eventually impacted the EBITDA, which is increased only 10%. So that is how we look into the EBITDA margin. When now the other element to be looked upon is the depreciation or amortization amount. So when we talk about depreciation, a company purchases an asset, it is used for a long period of time. So when I purchase an asset, I use it for a long period of time, and hence it doesn't make any sense to make the depreciation item. So when we talk about the depreciation item, a company when purchases an asset, say asset ABC, it is for a long period of time, and hence it does not make sense to show entire expenditure at once in the P&L. So that is why we are showing it every quarter. And hence when we talk about the income statement, we see depreciation amount shown in every quarter. Now another important aspect is the interest item, which is also called the fixed cost. Interest is an expense incurred on loan taken by the business. I have taken a loan, I have to pay the interest. So interest amount, if suppose I am paying large interest amount, that means obviously my debt is quite high with respect to current corresponding quarter. Say I am paying 10 crore interest with respect to 8 crore before, that means I have taken more debt now and I am paying more interest, and hence I have to also compare the interest amount with various other interest phases. Say for example, two companies in the same industry are paying an interest of 12%, whereas other company of the same industry is paying an interest of say 10%. So that is also to be seen upon. Changes in interest rate or currency fluctuation in the case of foreign currency loan will also affect the interest amount. Say for example, I have taken interest in dollar terms and I have to pay back in rupee terms. Now somehow the rupee depreciates, the domestic currency in the market depreciates. Now I have to pay more of interest for the same amount, and hence that is making a hell lot of hike in the interest which is being paid and which is being shown in the income statement. Now other income, as we have already discussed, the income which is not coming out of the operating income will be considered as a part of other income. This is the recurring income from other sources such as the rent, interest, dividend and commission, etc. It should be at best be small portion of the net revenue of the company. If this income is quite high in comparison to sales, it warrants analysis. So if the other income is quite high, it means that we have to dig into the other income part to look higher income is because of operations or not. Now after P&L, we'll come to other important statement called the balance sheet. Balance sheet contains the sources of fund for a company and application of those funds. So there are two items. One would be the source of fund and other would be the application of the fund. So obviously one, as the name says, source is application. The source becomes the source where the money has been taken, and the application, the money has been applied in this particular format. So sources and application. So when we talk about the sources, sources become the liabilities. And application becomes the asset side of a balance sheet. In general, the balance sheet, the liability and the asset side should be same. So when we talk about the liability side, we are talking about, again we are just dividing this side into two items. One would be the liabilities and other would be the equity. So when we are talking about the equity side of it, we'll also add upon the share premium. And the reserves and surplus. So whenever there is a question or whenever somebody asks what is the net worth of the company is always equity and the reserves and surplus. So for example, equity will include the share premium. So for example, a company ABC is into the picture. Now ABC will come with some certain capital and also they will issue equity in the market to raise amount from the market. Now the market might have given the premium to that particular issue and that would be included in the part of share premium. So equity is the amount which the company has bought with themselves, the promoters have bought, they have invested in the business, and the premium is the amount which have been taken, which have been raised upon. So now equity and share premium plus reserve would be the amount which is coming from the profit side of the income statement. So every year the company incorporates certain profit. That profit again is divided into two parts. One would be the dividend payout. The company will pay dividend the company will pay dividend out of that profit. Say the profit was 100 crore, the company paid a dividend of say 20 crore. That is 20% of the profit the company has paid dividend. Now there is 80% which the company has retained. This will go into the reserve and surpluses, and which the company might use in the coming in the future. So this particular equity plus reserve and surplus comes net worth. So net worth of the company is equity plus reserve and surplus. Now there is something called the long-term debt. Long-term debt is nothing but the debt which has been taken for long term, I mean which is more than a year or so. So for that particular debt the company might be paying some interest. So that is included in the long-term debt. And then comes the figure, the element called the current liabilities. Current liabilities are the liabilities which the company has to pay within 1 year. So within 1 year the company might have taken a liability and they have to pay back. That is the current liability. So they have to pay, that is why it is a liability. So when we add net worth to long-term liability and current liability, we'll get the total liability side of the balance sheet. Similarly, when we talk about the asset schedule, the application part of it, there would be certain assets which are used in the business time to time in a fixed manner. That would be the fixed assets which will not change. They will use certain assets like land and building are the assets which come into the fixed assets. Again, there would be current assets which are used in 1 year time frame. So the assets which are used, which are basically converted into cash in 1 year would be called the current assets. So for example, stock inventory will be converted into the cash, would be called the current assets. Maybe receivables that would be received in 1 year time frame would be called the current assets. So when I talk about the equity, this is the money which the promoter bring into the business. As I've said before, the promoter will bring into the business when it is launched and subsequently by additional shareholder as and when required. So equity is increased as and when required when they bring much more money in the future, that is also equity. So additional shareholder as and when required, who also become owners of the company to the extent of their shareholding. So for example, a promoter getting in 20% of the equity will become a 20% owner of the shareholding, and so this means that the owner would be on pro rata basis. So reserves and surplus, as the company makes profit, they are moved each year from the P&L. As I've said before, P&L amount will be apart from paying, after paying the dividend, the retained amount will be transferred to reserves, statement into balance sheet under the head reserves and surplus. Thus this is also shareholders' money which they choose to keep in the company and reinvest in the business. So this also becomes the shareholder money which would be reinvested in the business in some period of time, and hence that is why we have taken that into the reserves. So as I have told before, the net worth of a company is equity capital which the promoter bought and the reserve and surplus taken together represent the shareholder fund, also known as the net worth or the owner's capital. So as I mentioned there, the long-term debt, any debt taken for a period of more than 1 year. So if it is less than 1 year, that becomes the current liability. Now it is more than 1 year, is considered to be the non-current liability or long-term loan. This may be in the form of term loan taken by financial institution or debt security issued such as debentures. Investor prefer companies with low long-term debt. So that is why investor prefer company with low long-term debt, because they have to pay less interest now. So for example, a company which is getting a profit of 400 crores and paying an interest of 40 crores every quarter will be ending up paying an interest of approximately 160 crore in a year for 400 crores profit. And hence, even though the company is profitable, the companies might not be, the stock might not move as it should move because of the long-term loan. Current liabilities, these are the liabilities or payment which have to be made within a year. The salary, utility payment, trade payable, working capital loan, creditors are the current liabilities. They have to pay it back within a year. So maturing long-term debt and other are typical example of current liabilities. Current assets I have told, which will be converted into the cash within a year. So inventory, trade receivable, investments, short-term loan, cash are example of current assets. Current assets analysis is important to understand the working capital situation of the company. So now we will discuss a particular ratio called the current ratio. So when we talk about current assets and current liabilities, it is important to understand what amount of current assets and current liability is into the business. So when we talk about current assets and current liabilities, we will divide current assets by current liability to get the current ratio. So this current ratio should be approximately 1.5 times. The more this ratio, the better it is for the business. That means you have more money to pay down your current liabilities. So hence, the more the ratio, the better it is. If it is less than 1, that would be a case where we have to look upon, where we have to dig into the current assets and the current liabilities. So we have to check whether the ratio is more than 1 or not. 1.5 is taken as the industry standard.